Until recently, only the domain of the ultra-high net worth of pension funds, sovereign wealth funds, or other institutional investors. My guest today, Chuck Schreiber, CEO and co-founder of KBS, is bringing downtown America Class A office building investments within reach of every accredited investor. Welcome to the National Real Estate Forum podcast, episode 222. Thank you for joining me today. I'm Dr. Adam Gower, and this is the nationalrealestateforum.org, where I speak to leaders of the crowdfund real estate industry so you can learn how to raise capital, build wealth, and earn passive income from crowdfund real estate deals. The market is crazy hot at the moment, as it has been for a while. Try buying less than that. With interest rates starting to tick up, you're not really looking at much better than a 5.5%, 6% yield on your investment, even when levered. And what a headache having to deal with tenant issues, vacancies, maintenance, and, gasp, signing on, i.e. guaranteeing the debt. Plus, you've got to dump a bunch of cash into it just for the down payment. Given this perspective, it's hard to imagine that done properly, you can get the same kind of returns buying a Class A downtown office building in Chicago or Los Angeles or Portland or Houston. Not only that, but you can actually diversify across a range of downtown America office buildings, in contrast to buying that fourplex down the road where maybe a large proportion of your net worth is sunk into one property. Providing opportunities to invest in institutional caliber deals to every accredited investor is exactly what my guest today offers. Chuck Schreiber, CEO and co-founder of KBS. His platform, KBS Direct, is raising $1 billion with a minimum investment of only $10,000 from his investors for Class A downtown office high-rises, both core and core plus. Incidentally, things change very quickly, as you know, and particularly in the new world of crowdfund real estate investing. I spoke to Chuck a couple of months ago, and already his offering has evolved to be listed on the CrowdStreet platform, whose co-founder, CEO Tor Steen, was an earlier podcast guest of mine. To stay on top of all the developments in the fast-changing crowdfund real estate space, please consider subscribing to my Industry News Digest. I'm aggregating updates from a range of sources, and it's the only news digest exclusively focused on the crowdfund real estate industry. Subscribe by going to the show notes to today's episode at the nationalrealestateforum.org website, nreforum.org/KBS, forum.org website, nreforum.org/KBS. It's totally free, and you can subscribe by completing the form at the top of the page. Again, that's nreforum.org/KBS.
Well, I grew up in Southern California, and I'm fifth-generation Californian. Education-wise, I loved mathematics, and so when I went to college, I studied finance. I gravitated over towards real estate and real estate investments because it was an investment opportunity that I thought you could improve the performance of the assets by through its management, rather than selecting, specific securities. So I really embraced that. I was fortunate with a few firms to get started in the brokerage company, having my own firm, and then we formed. I got together with Cole Companies, which was a development company, back in John Cole and Peter Bren. It was Cole Brand Schreiber, but then turned to KBS.
Oh, okay. That's where the name came from. And what was the mission at that time?
Peter Brand had a relationship with a public pension fund, and he actually had closed the first bank portfolio from Nations Bank, and with that pension fund, it was a sizable transaction, greater than $200 million of cash was invested. They offered Peter another allocation. Peter was looking for a company that was a national company that had resources around the country. Cole had formed Cole Management Services Company and was building it up, so they had national presence in commercial property. And so Peter shared the opportunity with me, and I was fortunate enough to start off with one or two portfolios that were bank portfolios. We actually planned on doing maybe two portfolios. We followed on with a we called it a commingled fund, where there were 11 or 12 commingled fund where there were 11 or 12 different pension funds, mostly public pension funds, for about a $250 million allocation. Then we went back to a separate account allocation, and we were just fortunate to now we've done somewhere around 28 different funds.
So when you say you bought portfolios, you bought the assets, did you, from the banks?
What we did is we bought the first portfolio that I handled was an investment, a little over $200 million investment, and I think it was 32 different loan investments that were subperforming. The bank called them subperforming. I think they were actually non-performing. But they were construction loans to savings and loans, or to a bank, from a bank, rather. And the bank had identified those as bad assets, and they needed to sell them. They needed to liquidate them. I knew the loan officer, and so they set up a data room. They had about a half dozen different investors. And so they set up a data room. They had about a half dozen different investors who were interested in buying them. There were only maybe 4 or 5, 6 of us who from a real estate standpoint, who were buying these loans. And so we went ahead and bought that portfolio for, I think it was $221 million.
And when was that? Remind me. I'm sorry, you did tell me.
Yeah, we closed that in 1992 was the first acquisition.
Okay, so that was after the savings and loan crisis, wasn't it? That's what caused those to be non-performing. Is that right?
Adam, this is what damaged the market, was because there was so much overdevelopment, primarily for commercial properties, and there was so much vacancy. This is a time that it was very, very difficult to even sell a building because you couldn't get a loan. If you had a $20 million building, you could not go to the bank and get a $10 million loan or $12 million loan or a $5 million loan. And so the banks were trying to rid themselves of assets that were categorized, as bad assets or subperforming assets.
So you've seen and actually been active in some very severe downturns, haven't you?
Well, I think that I call that a real estate depression at that time. In 1988, the property values were just struggling in Texas, and then it just grew throughout the country. 1988, 89, 90, and it was a true real estate depression. And frankly, my perspective is, from a commercial standpoint, it was much worse than what we experienced in 2001, with the tech wreck, or even back in 2008, 2009, 2010.
Really? You think it was worse than the 2009-10 downturn?
Yeah, Adam, at that time, in 1991, you could not sell a building. You could not get financing on a building. So the only buyer of a building was an all-cash.
Have put in place here for KBS and KBS Direct?
Well, first of all, what it does, it makes us extremely sensitive to risk. So we're a fairly, even though we have a sizable portfolio, we're a fairly nimble manager of real estate products, and we have a posture where we flee from risk. So if we believe that something risky is going to happen in a marketplace or in a building or in looking out 2, 3, 4 years, we'll go ahead and sell assets in that marketplace or sell that building. We'll avoid that risk. We actually modified our investment strategy back in 2010 to focus almost exclusively on Class A CBD office. Up until that time, our investment strategy was really focused on B properties, buying B properties, putting what we had as cash. So we put cash in the building. Our investment strategy was really focused on B properties, buying B properties, putting what we had as cash. So we put cash in the buildings, fixing the buildings, making them a great location for businesses, lease buildings, and then sell them. But what we realized in 2010, the only buildings that were leasing were the great Class A buildings. So, for example, we bought a building at that time in Chicago, 300 North LaSalle, which had it was about 91% occupied. I think it's one of the best buildings built in that decade. It was built by Hines. And during that time period, with the majority of our portfolio, we weren't having any traction on leasing activity. I mean, we weren't even having people look at buildings because we were primarily Class B suburban office. Well, in a period of 9 months, we took that building, which was over 1 million square feet, and we took it up to where it's 98% leased. So we did in the balance of our whole portfolio. So we modified our investment strategy to focus on Class A and to buy the best building we can in locations that we've targeted as potential investment markets.
Well, that's very interesting because that is largely the strategy that you've employed in the KBS REIT that we're talking about. Tell me, why do you think it is that Class A outperforms so considerably the other asset classes that you've looked at?
Well, this frankly complements the principals who run businesses. I think that in 2009, 2010, a couple things happened. Number one, lease rates dropped in all products, in all office space. And what tenants realized was that they could sign a lease, move into a Class A building at the same lease rate they've been paying for a Class B building. But then what they also found is from 2010, 2011, 2000 to a Class A building at the same lease rate they've been paying for a Class B building. But then what they also found is from 2010, 2011, 2012 to today, I believe principals of companies value their employees much, much greater than they did a decade ago, maybe in the early 2000s. And so that building location, the environment of that building, the proximity to residential, so for example, the idea to have a building which would be attractive for a young, talented professional to work within that environment, work with that company, and to really enhance their lifestyle. So if they have an opportunity to live in a CBD, in a great CBD, whether it's San Francisco or some other great CBD, if they can walk to work or take public transportation to work or ride a bicycle to work, it becomes just a great place to live.
Performing during the downturns, the three that you've described, early 90s, 2000s, and then the latest one.
Well, that was interesting because in the earlier downturns, there was a lot of discussion about large tenants moving out of the CBD, moving into suburban, and my perspective was that people were locating and living out in the suburban communities, that they had great homes, and they didn't want to drive that 45 minutes or an hour to get to somewhere like downtown Chicago. They didn't want to do that. They wanted to be up in Lake Forest. They wanted to be up in other areas, in Schaumburg, Illinois, which was one of the premier suburban office markets in the country. But that's transitioned now because there's so many residential opportunities for example, in downtown Chicago, that people can just simply walk to their office. They can just walk to work, or they can take a train and get out. For example, in downtown Chicago, that people can just simply walk to their office. They can just walk to work, or they can take a train and get out. Take a train and get out right at downtown. There's so much residential development, multifamily and condos and apartments, for example, in west of downtown Chicago. Over the last 10 years, it's just changed downtown Chicago and the demand for office space there.
Isn't that interesting? Because this migration away from downtowns, what you're saying is you're seeing in certain locations actually being reversed because of the development of high-quality residences in the downtown areas that complement the offices.
Well, in nearly every downtown. I mean, markets such as Salt Lake City, which institutional investors wouldn't even consider 10 years, 7 years, even 5 years ago as a primary market. Now there are a couple of major tenants who've gone in and leased space of 140,000 square feet and then expanded for another 110,000 square feet in downtown Salt Lake City. And so it's become a wonderful, wonderful market we own 3 buildings there, wonderful market as an investor.
And that's because you see high-quality residential also going in.
And rapid transit, the ability to get to a job downtown.
So is that one of the criteria that you apply when you look for core plus downtown or core plus downtown assets, is that there's been a revival in residential development also in the same area?
Yeah, Adam, that clearly is driving it. That clearly is driving it. I mean, where does a professional between the ages of 25 and 40, who's talented, who's education, who has a great background, where do they want to live in their proximity to work? I mean, even be in a situation where their office is out in the suburban area, and even if they only have a 10 or 15, 20-minute drive to work, they have to get in. They don't want to get in their car at lunch to go get a burger or go to Chick-fil-A, or right. They don't want to get. They want to go to the lobby in the building. They want to go out in the patio, out on the side of the building. They want to go across the street to the mall. They want to go across the street where there's restaurants. Maybe even go shopping at lunch. They want to. We bought a building in Portland, Oregon, for example. Within this past year, one of the first thing we did was put 200 bike racks in the lower level of the building. It is so popular that it's something. These are brand new strategies. 10 years ago, we wouldn't even have thought of it.
Do you think technology is having some impact as well, Chuck?
It's tremendous. Everything we touch is tech related. Our offices, we look at our daily activities. Technology and the change in technology is impacting our life and will continue to impact our life.
So let's talk about this REIT that you've formed and are raising money for. So the investors in this fund have a minimum investment of $10,000. So this is very much a retail opportunity, even though you're looking only at accredited investors. But can you talk a little bit about how you came to decide to use this particular vehicle for raising a fund to invest in core and core plus assets? Because typically you would use the institutional route, wouldn't you, for that kind of investment? Why have you gone this particular? Why are you using this particular vehicle?
Well, in 2005, KBS formed KBS Capital Advisors, and we entered into the non-traded REIT business, focus on retail investors. KBS formed KBS Capital Advisors, and we entered into the non-traded REIT business, focus on retail investors. And there were a couple large investment companies that owned broker-dealers, and they educated us. And frankly, if somebody is for those REITs, our average investor is a $40,000 investor. So we did, for example, KBS REIT 3, where we did over $1.8 billion. The average investor is less than $50,000. And so we're passionate about that because that $50,000 investment may be as important to that investor or that couple because it's retirement money, we believe. And that's as important as a pension fund who's giving us an allocation of, $200 million or $250 million. And so we're passionate about those investors because we view that as retirement funds. Our seventh fund, which is KBS Growth, because we view that as retirement funds. Our seventh fund, which is KBS Growth and Income, began as a private placement. We raised over $70 million through a private placement, started buying assets, and a year ago, we started looking at the availability of technology for the retail investor who can educate themselves and make the decision, or deal through a registered investment advisor, make a decision to invest in a real estate product, and we have the ability to offer them institutional-grade real estate. So we have a portfolio which is a little less in value, a little less than $200 million, 4 different assets that are scattered around the country. And the strategy, again, the investment strategy is similar to what I shared before, is to buy top quality buildings generally in CBD markets. But we found that through this technology, and frankly, that investors have been able to educate themselves on a program which we created, which is a no-load, no commission product to the investor. So 100% of the dollars that the investor puts up goes right into the real estate. And we believe that we're the only firm that's done this. And it's hard because we wrote a number of checks to cover the upfront cost to create this. But we think it's going to be a very, very unique opportunity. And investors have the ability to go through and look at the fee structure, compare it to other institutional investors or even smaller investors, and really educate themselves on the investment opportunity, the potential risk, and the overall plan for the investment.
For the only news digest focused exclusively on the crowdfund real estate industry, please subscribe for free using the link at today's show notes page at the National Real Estate Forum.org website, nreforum.org/KBS. Website, nreforum.org/KBS. KBS.
Yeah, it's very interesting. Actually, I took the opportunity to read the PPM last night and this morning. And I am interested in the fee structure. Do you mind if we chat about that for a little bit? Because it is quite unusual.
Well, I'd appreciate it, yes.
Okay, so tell me, what are the fees and how do they compare to typical non-traded REITs?
Well, frankly, the fees are pretty consistent. As far as the operating fee, we get an asset management fee. That fee is based on the equity in the portfolio. But generally, when REIT vehicles or non-traded REIT vehicles are launched and investors are made through an advisor, there's traditionally a commission that's paid, and that commission can range anywhere from it could be as low as 3%, but it's typically a 6-7% commission, and it may be paid up front or paid over a 4-year period of time. And that rewards that broker-dealer and the firm for all of the due diligence they need to do, all of the research, all of the study. And, my perspective is that they earn that fee. Hopefully they're disclosing that fee to their clients, but they've earned that fee. There are some rules, some fiduciary rules that we believe will impact the market. That's going to make some challenging decisions for some of these broker-dealers. But that's really the tradition of non-traded REIT and the sale of investments. We believe that we have the ability through technology to provide enough data to the investor that the investor can make their own decision. The investor can educate themselves. Or if not, they can invest and get the advice of a registered investment advisor who really doesn't have a commission business. And so, we're enthusiastic because what it does is there really isn't that, the terminology, there's not the load commission business. And so, we're enthusiastic because what it does is there really isn't that, the terminology, there's not the load. There's not the 10% or the load, which would be the commission, and then the reimbursement for organization costs, origination costs. Those are costs we paid. We incurred that. And so it's a non-commission product. The other unique feature is, even though we're paying all those expenses up front, and there are some in the marketplace who actually don't recapture those up front, but what they do is they can recapture them in the future. They can come back and repay themselves and reimburse themselves. We're committed to pay those expenses, and it is simply our expense to create the product. And so again, we're selling it today at $7, or rather $8.75 a share, and all those dollars go right into the investments.
Now, from the investor's perspective, what do they get?
New value for the equity. The shares at that time will be adjusted. The share price will be adjusted to that value, but it should roughly be in the dividend range of $5 or 5.5% per year, and we pay a monthly dividend.
So the cash that these buildings generate is used to pay dividends to shareholders.
Correct, and we call that basically the dividend coverage, to make sure that we have cash flow from operating income that is equivalent or greater than the requirement for the dividend. So the dividend coverage is really a key element in these investments.
And an important component of your particular model, the non-traded REIT, is that shareholders can't sell their shares, can they?
Adam, this is not an investment for somebody who needs liquidity. This is similar to an investment club. This is similar to Adam. This is not an investment for somebody who needs liquidity. This is similar to an investment club. This is similar to if you and my brother-in-law and one other person got together and we're going to buy a fourplex office building. And we're going to buy this and we're going to hold this for a period of time. We anticipate for growth in income to have the whole period anywhere from a minimum of 5 years out to we could go as much as 10 years. But it is not a liquid asset. So if people need this money for education, for any needs during that 5-7 year period of time, this is not the right investment for them. This is an investment where our typical investor in here we think is going to be $100,000 to $200,000 investor. They're going to be receiving, $5,500 or $10,000 or $11,000 a year in cash flow coming back out to them, depending on the size of their meeting. The opportunity to grow in value, grow in equity, and build a portfolio where we hope to ultimately be with $500 million of equity. We'll have $1 billion portfolio. It'll be diversified throughout the country. So the average size of the investment, will be probably around a $60, $70, $80 million size, because these are sizable institutional-grade real estate projects.
Now, when you do sell them, there is a liquidity event, and at that time, is there a kicker in the distributions, or will it always stay flat based on cash flow? How does that work when you actually liquidate assets?
Well, we actually will go back to, if we, during the whole period, if we believe that we have an opportunity to realize return today that may not continue to grow in the future, we may sell assets and reinvest those dollars into other properties. But let's just pick a date in 4 years, 5 years. We actually go back to the investors and ask for their concurrence to liquidate the portfolio. And whether we sell the portfolio to one buyer, whether that's an existing traded REIT, whether it's an institutional investor, or and I'm anticipating that we'll have maybe 15, 20 different buildings in the portfolio. There may be, if we own 3 buildings in Seattle, for example, we may sell all 3 of those buildings as a cluster to one buyer. But in KBS's history, we typically sell buildings one at a time, and we find it's a way for us to maximize return for the investor. It takes more work to do that, but we're able to negotiate higher prices. Then we give them the return of capital and then the gain on sale.
Now, that happens on the fund level, does it? So the distributions are made kind of aggregated over the entire size of the fund, because you're not going to liquidate the entire fund. So the distributions are made kind of aggregated over the entire size of the fund, because you're not going to liquidate the entire fund at any one time.
That's not correct, Adam. When it's time to liquidate, when we believe it's time to maximize return to the investor, we will go ahead and sell. And we may, if we have 15 assets, we might have sold 3 or 4 or 5 of them separately, but we'll target within a 12-month period of time. We'll go ahead and sell all the balance of those assets.
Okay, so when you talk about having a lifespan of 5 to 7 years, if I was to make the investment today, or even 10 years, but at some point in the future, you do anticipate selling the entire portfolio, at which time one would hope that there is some equity increase. So I will receive a bonus in terms of the cost that I put in. So I might get some multiple or some additional dividend in addition to the 5.5%.
Correct. And the terminology we use is there would be, we call it a liquidity event, right? And that could be 10 properties within a year. But then we give the investors back their initial investment, and then that gain we call the gain on sale. And so if we buy the right assets, we'll have an opportunity for those equity to grow. And so there would be a gain in addition to the cash flow, which historically we've been paying out on a monthly basis.
And then you take also, if there is an increase in the value of the portfolio, the KBS takes what is called a subordinated incentive fee as well, right? That's kind of what motivates you to maximize the value of the portfolio.
Correct, and that's why we're in business. We're in business to be in a position to maximize return to the investor, to provide above average return to the investors, and then we participate in that higher return. So if we don't generate that return, but we're in business, for those incentive fees.
Very nice. So tell me, what are the biggest challenges of going this route? I mean, you're going the retail route. You've put presumably quite a substantial amount of your own money into building the platform to give small investors or retail investors the opportunity to invest in these assets that previously they've never had the opportunity to invest in. What are the biggest challenges you found in executing on this plan, perhaps that you hadn't expected when you started in 2015?
Well, one is a surprise that has surfaced. That the first challenge that we had when we sat down a year ago and decided we were going to do this was really cybersecurity. And so this was an area that was all new to us, and we've been really fortunate to surround ourselves with 2 or 3 different professionals to help us go through this. Because if you're going to put in your name, your social security number, that needs to be completely secured. The other thing is that we've had in our business, we haven't historically had a lot of marketing presentations directly to the investor, and so that's changed. So with this, with our website, with our communication, first of all, we have the flexibility. We can change it daily. We can modify and clarify terminology, but there's, for example, terminology that we just assume people may be very, very familiar. They're not. I had a young lad look at me, looked at our website, in which it stated that we're paying a 5.5% dividend, and his question to me was, "Is that good?" I said, "Well, Steve, if you leave it in the bank, what are you going to get? 0.14%? I mean, sure it's good." He said, "But I know, but this is real estate." 1.4%? I mean, sure it's good. He said, "But I know, but this is real estate. So is that good for real estate?" So I think we're very, very naive, thinking everybody knows that that that's a good solid return on a core asset. So we're in the process to consistently enhancing our return to really provide that data to the investor, to say, well, the alternative is to invest in a traded REIT, which is a very, very large business, a large product type, but their average dividend over the last year, I believe, is somewhere below 4%. Now, there's benefits there because it's a liquid asset. If somebody wants to buy $100,000 of that, and 6 months later they want to liquidate, they can sell those shares. So I discourage selling our shares because they probably would have to sell at a discount. But for us to think something new like that, to disclose that information, is really refreshing. But that was surprising to us. That's a challenge.
Yeah. So educating investors into what it is that you're offering is a novel idea, right? Because in the past you've typically dealt with folk that understand real estate very, very well.
Right, and to be sure, if we use real estate terminology or use a terminology which we may, when we're dealing with our peers or even internally, to be sure that there's an explanation. If somebody says, well, for example, this is a no-load product, so there's no commission. So somebody may say, well, I don't understand what a no-load product is. I don't understand why there would be, and then to be able to have information available so that somebody didn't have to leave our website and go research it, that the information is right there. As well as we build a team here that if people have any questions, they can call. They can call Ignacio, or they can call our team here. We build a team here that if people have any questions, they can call. They can call Ignacio, or they can call our team here and call Blaine and talk to our team here and get answers. So that area is something that we've really had to step back, and be sure that we're really, really crystal clear with our communication.
Now, is the volume of investors that are coming in matching the pace at which you're able to find new product to invest in?
Well, we launched this just a few weeks ago, so we're pleased with the level of interest. We're pleased with the amount of inquiries. We're pleased with the investments to date. But for this vehicle to really be successful, we would anticipate that by the middle of next year, we're raising, a minimum of $5 million a month, and probably looking at more of a $10 to $20 million a month. So we're buying like 42%. Our high end, we could record, if we buy a building which we believe if we have an opportunity to invest additional dollars into the building, sometimes we'll do that through debt. So an example might be if we bought a $50 million building and we thought that building should have, let's say, $3 million committed to its new lobby and elevators and parking and to really enhance the building. If it's a $50 million building, we might look and go to a lender and ask for a 50% loan to value, which would be a $25 million loan. But then we might record a loan on that building that's $28 million, and then hold $3 million in reserve and not fund it at the acquisition, but as time goes on, fund those additional dollars. So we would ultimately end up with a 56% loan of cost. That additional those additional dollars. So we would ultimately end up with a 56% loan of cost, but hopefully we're creating value, by putting in that extra $3 million. So I'm sorry, that was a long explanation, but it's typically our target's around 50%. The financing market is just absolutely wonderful for high quality properties. So it's a great way to enhance our returns.
And that's a very conservative level of debt, isn't it, Chuck? 50%. Why do you go with just 50% and not 80%? I mean, I know the answer, but do tell.
Yeah, it's typically the lenders that we're dealing with and our cost of debt. We might buy a building with unleveraged. The building could generate a 6% return unleveraged, and depending on the type of financing, we could record a loan so that our interest rate is anywhere from as low as up to the high end of 4.2%. If we get to you get to a 70% loan, that cost of debt's going to increase by 1% or like 100 basis points, which is 1%. So let's say our target is to have better than a 4% interest rate. If I do a 70 or 75% loan, that cost of debt would go to at least 4.5%, maybe 5%. So when I get to 5%, as an investor, I'm comfortable with 5%. So I'll take a lower loan and I'll participate in that cash flow. So it's really more of an institutional view. We don't need the financing to generate the return. The financing simply complements our return. So it's a pretty conservative institutional view of incorporating debt into our investment acquisitions.
Right, and also by having less debt, you're also less exposed to the ups and downs of the market.
Exactly. Plus, I have some that lower debt, whether I want to go back and extend the loan, whether I want to increase the loan, I just have much, much more flexibility because I have a lender that throughout the entire hold period is an ally and extremely pleased to have that loan on their books.
Is there any possibility that you might look at other asset classes inside this particular vehicle, or are you really strictly limiting yourselves to core and core plus? And perhaps you could just make the distinction for me or explain the distinction between core and core plus for a moment.
Sure. Again, we've really gravitated to these high-quality office properties. And so this is a cash flow vehicle. So we're not marketing and suggesting to people that we're going to have 2.5 or 3 times our investment capital coming back to them, or a 30% internal rate of return. This is a low risk, high quality institutional investment, and so these are core assets. So the buildings are not great. So the buildings are typically 90%, 92%, maybe 88, 87% occupied. A core plus property would be a property which was maybe a 75, 80% leased building. The current income is inferior to what income we would generate on the core asset. The potential upside may be greater, but we're taking some risk. And so this is a lower risk investment. This is we're not taking on that leasing risk. We do anticipate enhancing the portfolio by buying multifamily properties as well as distribution facilities as those opportunities will come along. The unique feature with office property, or really all commercial property, is since the Dodd-Frank rule was enacted, there's some pressure on lenders that really causes them and restricts the offering and the recordation of Frank rule was enacted. There's some pressure on lenders that really causes them and restricts the offering and the recordation of construction debt for spec buildings. So frankly, across the country, there are not enough office buildings at great locations. So lease rates have risen substantially, and stability and occupancy is very, very strong and stable because we have a very, very small volume of new buildings being built. So when somebody comes to me today and says, well, okay, where are we in commercial real estate? What inning are we in, right? That's the analogy they like to do. Well, I asked the question. I said, well, okay, I'll tell you what inning we're in if you tell me what's the weather going to be like tomorrow in the United States.
Right, exactly.
Right. So we're really enthusiastic about the markets, which I talked about a new market for us is Salt Lake City, because we think it's going to be very, very, very dim in that marketplace and build a spec office building. I think it's very, very challenging for them to do. there are only a few major, large office developers around the country who really have the capability of going out anywhere in the country and developing a building. And those are very sophisticated, knowledgeable, wonderful development groups. But as a result, the occupancy for these markets, for these submarkets, for high quality properties, have been very, very, very strong, and we anticipate being strong for a number of years.
Well, you've somewhat taken the wind out of my next question a little bit. I was going to ask you to prognosticate on where you thought the future was going to go, but I am going to orient that in a slightly different direction. Rather than trying to predict where the economy is going to go, where the market's going to go, I'm interested to know, now that you have become quite an advocate of the opportunity to publicly solicit online, brought about by the Jobs Act and various regulations. Future is of that part of real estate finance, the opportunity to appeal to the crowd for not just core investments like you're doing, but in general.
Well, I think it's a wonderful opportunity. We don't use the terminology crowdfunding because I think crowdfunding could be somebody who's going to invest $1,000. So we've, and ultimately we may be attracted to market to those type of investors, but we're marketing exclusively to larger investors, accredited investors, and registered investment advisors. But I think that there are 2 or 3 or 4 different firms, organizations who are actively involved in providing opportunities for retail investors to invest, large or traditionally smaller amounts of money into these. And I think if investors will just take the time to research the website, research the companies, look at the track record of the companies, look at the fee structures, and really get into the analysis, I think it's a wonderful opportunity for investors because the alternative is, I go back to my example, investing in a fourplex with a brother-in-law. And today that may be a wonderful opportunity, but if a tenant moves out or 2 tenants move out, all of a sudden you have 50% vacancy. Or if you need to come in, it is just a different type of investment versus we're giving investors the opportunity to invest in properties that are comparable properties that CalPERS or CalSTRS or New York Common or the State of Michigan Retirement System. Some of the best institutional real estate investors in the world are investing in these type of assets. So why can't a $200,000 investor be able to have that same opportunity? Or in the crowdfunding, in these type of assets. So why can't a $200,000 investor be able to have that same opportunity? Or in the crowdfunding, a $5,000 investor. Why wouldn't they be able to do it? Because they can get the information online. They can get the data. The technology is there.
As a real estate guy, what are the key daily habits that you have that make you and your business successful?
I think that something that personally I realized 20 years ago, and I'm very, very sensitive to it now, is the market changes. And so every day when our team walks in the office with an attitude of how do I increase the return to the investors, there are opportunities and the market changes. And so what risks are surfacing, but really, what's changing, what's happening in the marketplace. We're blessed in that there really isn't a market that we have interest in investing that we're not already owning a property. So that sensitivity to the market changes, I think, is in the real estate business is really, really a priority.
What has been the hardest lesson you've learned in real estate?
I think that and I knew this even coming out of college, is to surround myself with people who operate at a high level of integrity, and people who have the passion for the investor. When I started out in the business, I started in the brokerage business, and I was blessed to be able to interact with a tremendous volume of number of real estate professionals. But what I learned is in the real estate business, as an investment manager, and as maybe a general partner in a fund, in the real estate business, you can make as much money as you want to make if you don't care how you make it for a short period of time. To confirm that I surround myself with people who operate a high level of integrity. And in our business, where we're managing people's money, is to have a passion for the investor.
My last question. If you could give one piece of advice to somebody who has not yet invested in real estate, like your friend Steve perhaps, but is considering investing, what would it be?
Take the time to research. Take the time to research. There's so much available. And do a comparison. And before making an investment, look at comparable fee structures, comparable investment opportunities, look at track records of firms. All that information is available. And if it's not on the website, contact that principal, contact that sponsor, and inquire about it and have them justify what they're representing. I've seen on the web, I've seen representations that for returns, internal rate of return, which is an overall long-term return on invested capital, that based on what they have in their investment model, they can't achieve that return. So I just encourage people before they get committed, take time to research. It's available to them, and it'll take 2 or 3 or 4 or 5 hours. But I promise them that they're going to be much happier with their decision, by taking the time and educating themselves.
One of the key themes throughout my conversation with Chuck today was the importance of providing information to investors so that they can make informed decisions about what and if to invest. Towards this end also, I am producing a series of courses to help investors understand the DNA of different asset classes. One of them will be focused on downtown office buildings where, though useful in other asset classes, for example, Microsoft Excel is not enough to calculate the complex interactions between various lease lengths and terms, types of rental rates and other factors. It's a very different kind of asset class. Find out more by subscribing to the Crowdfund Real Estate News Digest, where I will announce when this course is complete. You can find access to the News Digest, as well as links to KBS Direct and other sites mentioned in today's episode, at today's show notes at the nationalrealestateforum.org website, nreforum.org/KBS. Next week, I'm speaking to one of Chuck Schreiber's partners at KBS, Lou Feldman, who also sits on the board of the CrowdStreet platform. Be sure to subscribe to the podcast series on whatever platform you use for podcasts at the nationalrealestateforum.org website, nreforum.org, and hitting any of the links that I've included about halfway down the homepage. Thanks for tuning Direct for sharing your time with me today. Until next time, this is Dr. Adam Gower signing off.